Well, good morning, everybody. Thank you so much for joining us. I'm Margaret Morales. I direct the carbon program here at Trellis Group, and we're having a conversation today, sponsored by Carbon Streaming, about how to accelerate corporate climate action with stream financing. So, this is a conversation I'm really looking forward to. Before we get into our discussion today, I'll do the quick webinar housekeeping that happens at the top of every call like this. We're on a really fun platform today, actually. You can move the windows around to customize whatever you want to look at. You can make the speaker slides bigger. We don't have a ton of slides today, but you can increase that when we've got the slide deck up. And then when we're in the discussion portion of our webinar today, you can increase the speakers boxes as well. So feel free to play around and customize your view. You can also chat with other attendees. Feel free to write in the chat where you come from. Where are you joining us from today? There's also a button at the bottom of your screen to download some resources, and we will have lots of time at the end of our conversation today for your questions for our panelists. So in the purple box, please feel free to submit questions, and I will make sure we get to as many as possible before we end our call today. So today, I am joined by a really great lineup of speakers. I'm thrilled to be here with you all. We have Steph Harris, who is from Microsoft's carbon removal team, Mitch Sowers, who's from the carbon project developer UpEnergy, and Xander Sabanis, who is the VP of Investments at Carbon Streaming. And our topic today is carbon streaming. There's often a big gap in the voluntary carbon market today where project developers need upfront finance to get projects off the ground, often with timelines that can be several years before they'll be able to issue credits on the voluntary carbon market. And on the other side of the market, you have buyers looking for excellent, high-quality carbon projects, but often not able to put in finance several years ahead of credit issuance. And so we're talking about stream financing today as a possible tool to help bridge that gap. Carbon finance is probably not the most exciting topic that you will discuss today, but we promise to keep this conversation simple and approachable, avoid acronyms. We'll call each other out if any of us uses an acronym, and to throw in a couple of puns. So with that, we will start off with a poll that has a couple puns. And this is just a fun one to ease us into the conversation today. Go ahead and answer. The question is, what comes to mind when you hear the term carbon stream? I'm sure the carbon streaming team gets funny answers to this all the time. Your possible answers are a body of water, emissions from a smokestack, something related to Netflix, or a non-dilutive project finance mechanism. So go ahead, let us know what comes to mind for you when you hear the word carbon stream. Xander, while we're waiting for answers to come in, what's the funniest one you've ever heard?
Ooh, I think probably related to Netflix. People hear streaming and they immediately go to whatever show they want to be watching instead of working in the VCM right now.
Relaxing, yeah, long binge entertainment at night. That sounds great.
Totally.
All right, so here's the answers. No one chose a body of water. 21% emissions from a smokestack. Only 3% said Netflix. That would have been my choice. 75% got the, I suspect this last one is the correct answer, a non-dilutive project finance mechanism. All right, well, I'm going to hand it over to Xander to walk us through what the true answer is to this question, give us an overview of stream financing, and then we'll dive into a conversation with our panelists. And like I said, I will leave a lot of time for questions. So as we go through this discussion in Xander's presentation, please send us your questions in the Q&A box. All right, over to you, Xander.
All right, thanks, Margaret. Thanks to Steph and Mitch for joining us here today. So yeah, I mean, looking at the results of this poll, I think the emissions from a smokestack, like that's why we're all here today. We're in this business to try to figure out how to decarbonize and how to reduce our CO2 concentrations in the atmosphere. I'm personally very excited about the other term of carbon stream, which is a non-dilutive project financing mechanism. And it's also the name of our company, Carbon Streaming, which uses carbon streams to achieve to enable these projects to happen. So I want to just kind of start off, Margaret, you kind of teed me up, like project finance might not be the most exciting, approachable topic. And frankly, I think a lot of people don't really care about how a project is financed. I always think about it kind of like a catcher in baseball. If they're doing their job, they're not dropping the balls, then no one really notices them. But if they start messing up, if they start, dropping pitches, all of a sudden it becomes a huge problem. And I think that's kind of a frame that I think about with project finance in general, and especially project finance with carbon projects. When incentives are aligned, when projects have enough capital, things work smoothly and you don't notice it. And so what we're going to talk about today, at least for the first part, is kind of what is a carbon stream and what are the problems that it's solving that enable it to be such an interesting finance mechanism for this space. Yeah, I think at the kind of the one takeaway that I want to have everyone think about as we dive into this is like what's the problem that a stream solves for? And I think fundamentally it aligns incentives across the various market participants, from the project development side, the financer side, and ultimately the carbon buyer. And of course, within all of this is the community where the project is occurring, and ultimately the success of the project. So the bigger environment, the atmosphere. So what is a carbon stream? Just have a couple slides here to demonstrate, because I think it's easier to just show a little bit of a graphic. I think what is really important to note is a carbon stream. It's a form of project finance that is not debt, it's not equity. People often say, oh, I understand it, but like, is it debt? Is it equity? It's neither of those two. Debt and equity are only two ways to finance a project. A stream is an entirely different mechanism, which, like I said, aligns incentives across market participants. In short, what a carbon stream is a carbon streamer, like our company, will provide upfront finance to a project, the credits as the project issues credits, sells them to an end buyer, and then takes a percent of the revenue generated from selling our investment in our return back. So here in this little diagram, carbon streaming is the project financer. There's a project partner. Let's just say it's somebody who's planting 1,000 hectares of trees, and they need $1 million to do it. I'm just making up numbers here, but stream financer like carbon streaming will provide what we call an upfront deposit. So basically, this covers the cost of planting those trees. That's typically staggered over a series of milestones. Maybe in this example, as the developer plants more and more hectares, we would provide more and more funding to them. And so that enables the project to get off the ground to the stage that it can actually be issuing credits. So then once the project is delivering credits, the credits come to us, come to the streamer. And then on the other side, we sell those credits to buyers of those carbon credits. So that could be, most commonly, that's a company that's looking to offset their unavoidable emissions, the streamer from the sale of those credits. And then this is where then basically we do a revenue share on that money that's coming back to us. So let's just say for every dollar that the end buyer spends on the credit, 80 cents of that goes back to the project partner. Again, this is just making up numbers here, and then in return, that project partner uses that money to fund the project, give money to the local communities, and take basically earn their return on the project as well. So I think fundamentally it's a very simple idea. I think people often get confused, but we provide capital. the project partner implements the project. Then we go and sell credits. We can co-sell them with the project partner as well. And then the revenue from that flows back to us. And we take a piece of it to earn our investment in return, and the rest goes to the project and the local community. So that at the kind of the most simple level is what a carbon stream is. And I would be happy to get into more technical details later on, but think that's kind of a good place to kind of stop that explanation. I think the thing that really matters is like what problems is this solving that maybe other forms of financing don't solve. And again, streams can be used in collaboration with other types of financing. But really, we see this as like what's the problem that we're solving? And I don't want to go too in depth on the slide. These will be available for download later. But basically, carbon buyers and project developers have different needs, and that leads to some misalignment. So just super simple example, often purchasers of carbon when the credit is issued, project developers need capital to develop the project and implement it. And there's often a time lag between, let's say, when you're planting your trees and when there's first credit issuance, which could be 5, 6, 7 years down the line. Another example would be carbon buyers really want to buy from like highly vetted projects, and carbon developers, everyone says they have the highest quality projects. So there's another function where carbon streams can come in, and we can like provide that upfront capital to solve that timing problem. And because we're actually putting our own money in and our own skin in the game, perform a lot of due diligence, have a lot of disclosures, especially carbon streaming as a publicly traded company, which we can also get into later. So there's a whole bunch of different problems that this solves for, but fundamentally, I think the reason why the streaming model is interesting is about aligning these incentives. So I'm going to stop there, and then we can dive into this more as we continue the conversation. Back to you, Margaret.
Okay. Thank you, Xander. That was great. Thank you for setting the table for us here before we dive in deeper. And I see we're already getting really good questions, so thank you very much. All right, well, before I turn to our discussion, we've got one more poll here for the audience. And our question is, for carbon credit buyers, what keeps you up at night? / what worries you most about your carbon credit investments? Or what matters most to you? So let us know what you think. If you're a carbon buyer, answer from your own experience. And if you're not a buyer, but perhaps you interact with some in your work, let us know what you've heard or observed. And the answer choices are A, integrity of the credit, B, locking in long-term pricing, C, locking in long-term access to credits from a project that you have due diligenced, or D, the co-benefits associated with a project. So let us know what you think. What's the number one thing that keeps Steph up at night? And in a second, once we get a few more answers, we'll see what she has to say. All right, let's see. If I had to guess, well, I'd probably guess all of them, but here we go. Okay, number one, by far, most folks said integrity of a credit, which is really interesting because I think what we mean by integrity can also be different, and that's something to dive into. So 78%, almost 80% said integrity of a credit, almost 10% locking in long-term pricing, and similarly for locking in long-term access to credits. And the fewest folks focused on co-benefits. So, all right, thank you to everybody who answered that. So now we'll turn to our discussion here with the panelists. And in fact, I'm going to start right off by turning to you, Steph, and asking, how would you have answered that poll?
Thanks, Margaret, and thank you for having me here today. I would probably echo the poll, although I would have liked to have an E, all of the above. I think all of those points are really important from a buyer's perspective. But I'd say right now, and I know for the last couple of years, the conversation has really been about the quality of projects and the quality of credits. So I think that folks in the audience are spot on with kind of what keeps them up at night with regard to procurement.
Okay, thank you. So I'm going to just flow right from that into my question about stream financing. I know Microsoft has worked with a number of different financing models on different projects across your portfolio. But I'm curious for you to share sort of what are some of the benefits that you've experienced as a buyer with the stream financing model?
Yeah, absolutely. So first, I will echo what's been said so far, and thank you, Xander, for that really helpful introduction and overview. The first benefit that we see to a stream financing model is channeling capital into early stage projects. Microsoft has a goal to be carbon negative by 2030, and we're going to need every tool in our toolkit to make that happen, and particularly for nature-based projects where trees effectively need to be in the ground today in order to start sequestering meaningful amounts of carbon by 2030. And the voluntary carbon market has historically been seen as risky to many traditional investors. And I think long-term outlooks are still a bit unclear when it comes to financial returns. So while we wait for more of these traditional investors to enter this space, streaming is one model that I think is really helping bring much needed capital to early stage projects, many of which have significant upfront financing needs and rely on third-party capital to get their projects up and running. It is no insignificant feat to get millions of trees in the ground, or even tens of millions of trees in the ground over thousands or tens of thousands of hectares. And so those upfront financing costs can be real, and having folks come in to support that early on is really meaningful for bringing these high quality projects to the market. And I think another benefit of this model is that it provides insight to all of the parties involved into how early stage finance is allocated to specific project activities. So for example, with nature-based projects, we'll get very detailed insight into how money is being dispersed into different project activities. So this could include nursery establishment or labor for seed collection, or how money is distributed to landowners upon maybe signing a land lease. And we'll get maybe biannual or quarterly insight into how the project is performing, both against the expected budget as well as key development milestones. Xander had started to mention this as well. And we get insight into that well before the project even starts generating credits, or maybe even at the pilot stage of a project before a project has a validated PDD. So I think this process does align really well with Microsoft's project due diligence process. And I can talk about that a little bit more later. And I think one other benefit to mention is the overall cost. So for the, whether we're sitting in the streamer role or maybe downstream from that, if we're providing capital to the project developer in exchange for credits, there might be a discount that we receive because the developer is actually utilizing our capital instead of seeking that third-party financing elsewhere. Traditional investors are probably going to expect a much higher return on their investment. And there are risks associated with this model to a buyer. You're dispersing money into a project, putting capital at risk before credits are actually generated. So we could talk about some ways to potentially mitigate that risk. And I think those would apply kind of across the whole value chain of the stream. And happy to touch on that a little bit later. And then lastly, I think just general portfolio diversity. Margaret, as you mentioned, there's a number of different project financing models. And so the Microsoft CDR team is aiming to build a really diverse portfolio of projects in, the diversity of pathways we're considering, the durability of stored carbon, the geographic diversity of project locations, and also in how we think about project financing. And so this is one procurement model that we've employed as we're building a relatively large carbon removal portfolio towards our 2030 target.
Okay, thank you, Steph. And I think that issue of the time lag where the carbon buyer's timeline isn't always the same, it doesn't match the carbon project developer's timeline, is really interesting, like an interesting place where carbon streaming can play a really important role. So, Mitch, I'm curious to hear from you as a project developer. What has it been like for you to work with a streaming finance model?
Yeah, thanks for having me, and thanks for the question, Margaret. So first and foremost, UpEnergy is an organization that's focused. We work across clean cooking, water, and carbon removals. And we, as you point out, we are in partnership with carbon streaming and worked on carbon streaming deals before. And I would say there's quite a number of benefits, but probably the ones that I would highlight here, I think, would one be the alignment of long-term incentives. And so these arrangements tend to go throughout the lifetime of the project itself. And as we all know, for anyone that's involved in these markets, a lot changes between, a 1 or 2 year period, let alone a 10 or a 15-year period. And so this sort of structure as a developer gives us the ability to sort of work with our financing partner as things adapt and change within the market, to really help make sure that the projects and the activities and the interventions that we're conducting on the ground are ultimately producing the types of credits, certainly focused around some of the topics that were brought up at the beginning, around integrity, things of that nature, are continuously adapted and iterated on throughout the project lifetime. I also think that this structure for us allows us to sort of look at the market holistically and the scale of what we're trying to do on the ground. As an impact-focused organization, we really do try to deliver projects at scale that can deliver impact at scale. And obviously, in order to be able to do that, we want a financing structure that is scalable, and we see that in the streaming structure itself. For example, I think one concrete benefit of the streaming agreement that we have done with carbon streaming and community carbon is the implementation of an impact fund, right? And so that basically what that means is that there's a certain percentage of all revenue that's generated from this project that is going back to tangentially related activities, such as supporting like long-term social benefits and climate benefit programs, such as supporting women and girls' education in the countries where we operate. And those are examples of things where a streaming deal allows us as the developer to sit down with somebody on the financing side and really say, hey, this is not only the right thing to do, but it makes a lot of sense because, as we heard from Steph before, these are things that buyers may be looking for, and it makes sense for us to include, where in other forms of financing you wouldn't necessarily find that level of flexibility. I think on the challenges side of this question, or sort of maybe not necessarily a downside, but a challenge, I would say it's a very long-term partnership, like I pointed to, right? And so it really is important for our side, as well as the financing partner, I would assume, to work on diligence, to really get to know your partner, understand what they're all about, because you're not getting into a situation that is going to terminate in 2 years or 3 years in most cases. In our case, in case of Cook Stoves, we're talking about projects that will go on for 15 or 20 years with continuous deployment. And as we heard from in some of removals work, will go on even longer. So that's what I would say to that.
Yeah, it's very much a long-term relationship between a project developer, an investor, and even in some cases with a buyer as well. So perhaps very much vetting in both directions. So each of you have brought up due diligence, and I know that's an important part. It's absolutely vital to how buyers think about which projects they're going to buy from. Sandra, I'm wondering if you can walk us through, how does carbon streaming think about carbon project due diligence?
Yeah. So I think what Mitch was just saying is spot on. When we find a project that we like and want to invest in it, we are a partner of that project for often 30 years. And so what that means is we have and we're funding that project, we're representing that project to the market. We have a 30-year relationship with that project. And so due diligence is absolutely crucial. I think one of the things that we think is notable is like, we're putting just saying, oh, this is a good project, someone else should buy it. We're saying, hey, we've done all of our homework and we're willing to kind of put money behind that DD. And so I think that is something that for people who are looking to buy credits to understand, because I think again that shows an alignment of incentives and long-term thinking that we want these projects to succeed long-term, and we have this long-term relationship. So if they don't, we actually bear a lot of the more downside, arguably, than just someone who's purchasing credits, although it's not good for anyone. So I think there's a couple things I would say. So because of the importance of this due diligence, we take the DD process extremely seriously. We perform extensive diligence from an operational perspective. So, the history of the developer, what do their operations look like on the ground? Are they able to actually execute on the plan that they've laid forth? Financial due diligence, will they run out of money? Is the project financed in a sustainable way? Technical DD are looking at carbon projections, looking at, if the climate is changing in this place, as it is everywhere, how will that affect things long term and those carbon numbers? Legal DD, how's the company there's a lot of nuance around different jurisdictions and country level policy and expected future policy, because as everyone here knows, policy is evolving rapidly in the voluntary space. And so we have a team that focuses on this both in-house. So we have our own legal, financial, and technical resources at Carbon Streaming to perform these analyses. But then we also hire third-party technical to basically ensure that we've caught everything that maybe knows a country really well or a specific methodology. Carbon Streaming invests in projects, a wide variety of projects, everything from avoidance to removal to all these different jurisdictions. So we can't be an expert on every country, every methodology. We can be pretty good, and then we make sure that we're partnering with third-party experts that can go in and validate all of the things that we are assuming or hoping that we see in a project, and we gain a lot from that. And then once we've kind of done all of this, I think it's important to note that we're a publicly listed company, and so in addition to our own what we want to do, we're held to a very different and higher level of regulatory compliance and fiduciary responsibility than we would if we weren't a publicly traded company. And so basically, we have to go above and beyond all of these standard requirements and disclosure. We have a lot of disclosure requirements, which fundamentally we believe brings transparency to the market and leads to a more thorough process. So once we've done all of our homework, we've done it in-house, we've done third-party, we'll present that to our investment committee and then ultimately to the board. And then after that, we'll move forward with an investment if everything looks good. And so I think there's these multiple layers of screening, ultimately, we believe give buyers confidence in the integrity of the projects that we do decide to invest in. But a byproduct of that, too, is that we have a lot of resources that have been compiled, third-party technical reports, internal technical reports that we can then share and collaborate with buyers to help them along their process. Because oftentimes people want to do their own diligence as well, which everyone should do. So I think from a high level, that's kind of how we approach DD.
Mm-hmm. It sounds very extensive. Xander, how long, can you give us an average, how many months does it take the team to due diligence a single project?
Good question. If everything goes according to plan, we would strive for it to take typically 3 months. I think I have never seen a project actually do it in 3 months. It's typically closer to 6 months. It's sort of like an end-to-end review. But again, it kind of depends on how far along the project is, because often they're still evolving pieces that we're waiting on. So if everything were just laid on the table day one, I think it could be quicker. But something that we're seeing, and I believe is, Steph might be able to comment on this too, is as buyers are starting to want to move to earlier and earlier stage projects and sort of have their fingerprints on the projects so that they can shape them to meet their own corporate needs and goals. And so I think as that stage projects, some of these questions can't be answered until they've been fully solved. So it could take a.
Okay, interesting. Yeah, Steph, I'd love to hear, how does the Microsoft team think about due diligence, and especially with early stage projects?
I will echo a lot of the categories that Xander already mentioned are similar kind of due diligence buckets that we are also investigating. That can be kind of the actual carbon integrity itself. How are you setting your baseline? How are you, what are your additionality claims and assessments? What are kind of methods are you using for carbon quantification? That would be one area of DD. We're also going to due diligence the project developer and the project implementation partners and who's actually involved in doing the work on the ground. We're also going to look at things like environmental benefits and environmental harms and risks associated with that. So kind of similar categories that Xander already mentioned. The flow of our DD process, and from what I've heard from suppliers that have gone through this process, is that I've heard it's quite rigorous, but we have 3 primary phases of, I think we'll wear that with a badge of honor right now. There's 3 primary phases to our due diligence. There's the first phase, which is kind of an internal desktop review by one of the buyers on our team who's reviewing preliminary project documents and submissions that come in through our RFP portal. Again, looking in kind of specific buckets of due diligence and just assessing for general data completeness and sufficiency. And then our second phase of DD, we bring in a third-party technical advisor. We use the acronym TPTA, and we bring in a TPTA to support do another desktop review. This is intended to identify any major red flags that we see at this phase that we don't think can be mitigated through the project design or through incorporating something into a contract. And assuming everything checks out with the second phase of DD, then we would do a third phase of DD, which is a much longer phase and more detailed, usually involves a site visit that we'll have our third-party technical advisor go to the project site with the project developer and really dive into the risks that were identified in that second phase. And that's where we will think through what are all the potential mitigation options for all of the different risks that have been identified. Is this something that needs to be incorporated into the project design itself, as Xander mentioned, kind of having our fingers on like where can we mold and shape what the project developer is doing to be in line with our quality criteria? Is this just an information risk? We just need to know about this. And so there's a reporting requirement that we might put into the contract. And we just want to know about these things and make sure that the project developer is doing what they said that they're going to do. Is this something that we need to think about in the contract? If this scenario happens, how would we manage and mitigate that? And oftentimes we might be thinking about really fringe scenarios, but that's what the contract is intended for, is to dictate what happens when X scenario happens and how do the parties address that. So each of our phases is intended to be a stage gate where we make go, no-go decisions about whether to move projects forward into the next phase of due diligence. And kind of, again, echoing what has already been said and what Xander mentioned, is Microsoft's procurement is moving into more long-term, where we're looking at contract structures of 5, 10, 15, 20, 30 years at this point. And so we really want to do all of our homework up front. We view these relationships as very long-term relationships. And so undertaking a relatively rigorous due diligence process, I think, allows us to have confidence that we understand all of the risks and we have some solutions on how we think we can mitigate those moving forward. I don't think any project out there is perfect. There's going to be risks associated with every project. It's just having a very clear understanding of what those risks are and then what you do if those risks arise. And I assume you'll ask this, Margaret, so I'll just go ahead and answer. How long does this take?
Yeah.
Our goal is for it to take about 6 months, but like Xander mentioned, can often take longer. A lot of it is dependent on data availability and project maturity and project developer sophistication. So it can take 6 months, can take 9 to 12 months at the same time. So, yeah.
Okay, thank you. I guess our hope would be that as everybody works together in the carbon market, that we get closer and closer to the 6 month or maybe even a future 3-month gold standard. There are so many good questions coming in. So I'm just going to turn real quick to you, Mitch. I'd love to hear sort of your perspective as a project developer on the due diligence process and what you've experienced. And then after that, I'll turn to our audience questions because we've got a whole lot of good ones coming in. So first, Mitch, please tell us what it's been like for you to go through due diligence on a project.
For sure. So, it's interesting. Obviously, we're very familiar with extensive diligence processes in all financing that we've done. And I guess a lot of it was said kind of on the more standardized financial diligence, things of that nature, and we see that be quite rigorous across the board. I would say, I'd kind of focus in, I guess, as a developer on a few things that we do internally that kind of help us through the diligence process. And, UpEnergy has been developing projects for almost 15 years now, and has a lot of expertise coming out of carbon markets. But internally, we really take a lot of care in the way that we design projects. And we have a team of over 20 staff that are technical experts in different areas. And so, that also kind of acts as internal diligence, but really helps us work with partners as we're designing projects and helping to bring the financing to those projects. One example of that we work on would be sort of kind of seeing the questions around from buyers or financing partners, and deciding on one of our charcoal stove projects over a year ago, start putting digital sensors, digital monitoring on those stoves. And that goes to the question of project design and ultimately questions that, would be similar to those that we would see through the technical piece of diligence. So I think it was Xander mentioned as well on the policy side, right? A lot of the countries, I think that it's important to highlight, like the countries where we work is 8 countries in Africa, and a lot of these project activities are taking place in countries with either non-existent, new, or rapidly changing kind of regulatory landscapes. And so we, as a developer, put a lot of care into that process as well, in terms of building and maintaining strong relationships with the host country governments where we operate, because we see that area being an area where it really takes our expertise and our help to work with a financing partner to be able to understand that landscape, where it's headed, and sort of demonstrate our ability to navigate that scenario on the ground. And the final thing that I would say that I think we take seriously and I've seen come up quite important in a diligence process as a developer is that we are very on the ground present in the markets where we operate. So we have teams, local staff in all of the projects that we're developing. And I think, the benefit to that is, from the household or the school where we're conducting an intervention, all the way up to the financing partner, we have the ability to understand what's going on, to be there with the end users, with the financing partner, and really make sure that that project is built the way and is quite frankly being executed the way that everyone that's involved in this expects it to be. So maybe a little bit of a different answer, but I would say those three kind of buckets are things that we really put a lot of care into, to both diligence ourselves and make sure that our projects are as high quality as they can be, but we see come up as unique to our industry in a diligence process.
Okay, thank you so much. It's really at the center, I think, of this entire conversation. So, all right, as I said, now I'm going to go ahead and move us to our audience questions. So many good ones coming in. So we'll do our best to use the remainder of our call to get through as many as possible. And I'm going to start this first one and direct it to you, Xander. The question is, how are carbon streams the same or different from an offtake pre-purchase agreement?
Yeah, so this is a question that we get a lot. I think there are I think you can structure offtakes and streams in kind of a similar way, but I think the key difference is offtakes are often for a set volume of credits at a set price for a period of time, and sometimes that period of time can be quite short. I think a stream is typically long-term. It's typically the life of the project. It also, like we talked about at the beginning, is based on a percent of revenue share back to the project. So you can structure streams in a lot of different ways, but I think kind of fundamental to that model is that there is that percentage that the streamer takes to earn their investment back, and the rest goes back to the project. But as prices go up in the market over time, the project developer, the community can participate in some of that longer term upside. And so I think that's a kind of a key difference. But within that, we can then as the just pieces of that stream for whatever period of time, maybe they want a 1-year offtake or a 3-year offtake, and we can work with them to figure out how to do that, taking into account the needs of the developer as well. So there's some similar elements and some key differences.
Okay, thank you. Always good to clarify definitions of terms that can still be used very differently in this space. So I'm going to keep you on the spot here and ask you a follow-up to that one. This question is there an expectation from carbon removal buyers, CDR buyers, to put forward upfront capital in the streaming model? And the person clarified, the slides in the beginning seem to convey that carbon streaming addresses the time gap between upfront capital and pay on delivery, but is it also expected that buyers put up upfront capital?
Yeah, it's a great question. It's one we get a lot. So I think typically in a stream, one of the benefits is solving that time gap problem. So being able to provide capital before a project is ready to issue credits. I think what we've seen in the CDR space is it's very supply constrained right now, and also there are buyers who want to participate both in an offtake from the stream, but may also want to take some type of position in the project long term and do some kind of upfront capital investment in the project. So that's something we see both. We see we work with projects in kind of both scenarios, and so I think fundamentally, like it depends. It's a bit of a cop-out answer, but I would say, like, yes, our goal is to provide that upfront capital, but depending on the needs of the buyers, it also could make sense for them to engage in kind of a similar upfront payment with the buyer, but not always. And I would say it's a bit case by case, and happy to chat more about that offline if anyone wants to get into more specifics.
Steph, do you want to jump in and share how you all have thought about that?
Yeah, absolutely. I think similar to exactly what Xander just said, it's going to be project by project, case by case dependent. And in some cases, I think the general answer is no, a buyer does not have to provide upfront financing in this model, I think that's generally the role that the streamer is playing. So, for example, carbon streaming in this instance, but the buyer can, and I think that's going to come down to what are the buyer's priorities, what goals are they trying to meet, what are those, what are the public-facing goals and targets, how much risk is your organization willing to take on, is credit volume and certainty more important, or is pricing important, or is timing important? What role is your organization actually trying to play in the market, and how you achieve those public-facing targets? So I think answering a lot of those questions and what kind of factors need to be considered in order to participate in a stream or not, whether you're actually providing financing up front or are the recipient of credits from a streaming model, I think a lot of that will just be dependent on the organization's priorities, what they're trying to accomplish, and then the role that they want to play within that project and that transaction.
That makes sense. Sounds like some of it comes back to that second poll we ran about what keeps you up at night. All right, I've got another question for you here, Steph. The question is, how does carbon streaming mitigate the market price risk against its own return and project developer return? So actually, I'd be curious to hear from you, and then also Xander, to hear a perspective. But Steph, do you want to start with mitigating market price risk?
Yeah, I know that. I think that question was specifically for carbon streaming and Xander, but I can talk about generally one of the roles that Microsoft wants to play within the carbon removal space is to mitigate some of the price risk. As I mentioned kind of at the top of the hour, the voluntary carbon market has been seen historically as pretty risky. And I think that's one of the reasons why there's not a lot of traditional financing within this space. And so for Microsoft to come in as a buyer and commit to a long-term multi-year offtake from a project, often at fixed prices, kind of under that offtake model that Xander mentioned, that provides certainty to either project developers or carbon streamers who are taking on a lot of risk by putting capital into these projects that's desperately needed to get these projects going. And so we see one role for us is to provide that guarantee. Again, it can be over a 10, 15, 20-year, even longer offtake, providing some revenue certainty to developers and streamers who are putting their own capital and essentially like sweat equity at risk.
Thanks. And Xander, yeah, I think that, it'd be great to hear your thoughts on this question as well.
Yeah, just kind of, so carbon streaming kind of has two approaches. One is for most of the projects that we've invested in, we have investors who want long-term exposure to carbon pricing. And so we are willing to take on that market risk. And we're confident that we'll be able to sell these credits in the future. At the same time, as we've talked about a couple times, the market is, has its risks. And sometimes from a risk management perspective, we want to lock in cash flows, whether it's for us or partners who, need cash flow to run the project, to make payroll. And so we work with the developers and also kind of internally as we look at risk in our portfolio to balance locking in for periods of time at like fixed or index-based pricing with taking on that market risk. And so that's continually something that we try to balance in a specific project and then across our portfolio.
Okay, thank you. I'm going to turn us now to a question about actual project implementation. And Xander, I'd be curious to hear your take on this one first. The question is, how hands-on are streaming providers during the implementation stage of the project once they've provided that upfront funding? And how do you find that right balance between the project developer and the streaming provider in implementation of the project?
Yeah, great question. So in theory, stream financers and where stream financing has been used quite a bit in like the metal and mining space, where typically operators are much sophisticated, hands-on, much larger, have bigger balance sheets. So our financiers, if you think of it as almost like what's the role of a bank in a project, the bank lends money and then takes interest payments or whatever it is. So I think from a point, the biggest difference that the carbon streaming model has is we take we're very hands-on on the sales side of the credits. We have 25 projects. We have a sales team that has relationships. That I wouldn't say from the we are not getting involved in project level activities. But we are getting quite involved on the credit sales side of it. I think the other thing to mention is oftentimes project developers have, they've worked on a few kind of specific in specific regions, and we have a lot of sort of hard-won lessons that we've learned just from doing a lot of carbon deals over the years in a lot of different places. And so to the extent that we can be helpful to the development partners by sharing some of that, we try to get involved, but fundamentally we are not the project operators. We pick project operators and developers that we are highly confident can execute on the plans entirely on their own. So.
Okay, thank you.
It's over to
Mitch,
you,
I'm
Mitch.
curious for your perspective on that as well as a project developer, and even maybe even zooming out from how involved a streaming financer gets involved with project development, but even other types of funders or buyers. Like, how do you find that balance between who's driving the project?
Yeah. I mean, I guess the true answer would be sort of the non-answer that it varies, right? And I think it sort of varies depending on structure that you're looking at, the type of financing that you're bringing in, as well as the partner themselves. And I think that's where, as we, are out there speaking to and have relationships with lots of different financing partners, and we get to know them, on both sides, you're really looking for those partners that you can work with. In the case of, I mentioned this in my first answer, but in the case of streaming arrangements, I think it is quite involved, but not necessarily in an overbearing way. I think our experience would be similar to what Xander provides, right? Which is we're, from a technical capacity, from an implementation perspective, we're doing a whole lot of things. And that's our bread and butter. And that's what we've been doing for a long time. And I would say there's not usually a ton involvement from that side. And that would hold true across multiple financing partners. There's definitely diligence on that, and there's expertise, and there's questions along the way, but there's we haven't necessarily a whole lot experienced a whole lot of do something this way or do X or do Y. But on the other side, when you have something like a streaming structure, it is in the incentive of both parties to continuously understand what's going on in the market. Where does the project fit in the market? What can we be doing to enhance this project as time goes on? And so those conversations are happening on a very, very regular basis.
Okay, thank you. Really interesting to hear that. Let's see, we got a couple of questions about minimums, both what is the minimum number of credits that a project needs to issue to be considered for stream financing, and is there a minimum investment amount? Xander, can you answer those questions?
Yeah. So again, it depends. I would say basically the way that we would think about it, because we've invested in issue a few thousand credits a year, and we're also invested in projects that could have hundreds of thousands of credits issued a year. So I think frankly, the answer, and this is carbon streaming, but I would say this is probably most investors in general, is the project has to be large enough that it's going to be worth spending the time. I mean, if we're talking about 6 months of legal and diligence, I mean, there has to kind of be some minimum threshold. Where that sits, it's probably typically a few $1,000,000, I would say, and I think that's probably a better way to think about it than number of credits. Biochar credits are trading at, I don't know, 150 euros right now, and other credits are trading for a couple dollars. So I don't think it's right to think about it in terms of quantity of credits, but I would say it's probably typically a few $1,000,000, and depending on the strategy of the investor, maybe moving towards bigger ticket sizes as the market matures, because often it's the same amount of work that an investor has to do, whether they're investing $3 million or $10 million or $50 million. And so just need to make sure that it's sort of worth everyone's time to engage in that kind of relationship.
Okay, thank you. Let's see, I think we've got time for a couple more questions. So this next one is about how carbon streaming and buyers work together. So I'll ask you first, Xander, and then would love to get your thoughts as well, Steph. The question is, what are the dynamics between carbon streaming and the buyer? Do buyers bring the projects they're interested in and that need financing, or does the developer bring the project to carbon streaming? Like, how is this triangle formed?
Yeah, great. I love that question. I think historically what's happened is before there were a lot of buyers in the market, the carbon streaming invested in projects and then work with buyers who are ready to procure the credits from projects in our portfolio. I think as the market has matured, we've seen a bit of a shift where buyers often have projects that they really like and they want, but they're not able to fund them from the get-go. And so that's kind of a model that I think actually works really well, where buyers will say, hey, we have this project we like, we need to finance it. Can we work together to shape it and get the financing right? And so we've actually been doing more and more deals like that recently. And I think that is, it's this kind of evolution of the market as buyers get more sophisticated in understanding what they want, and as their team grows, both in terms of size and capability.
And Steph, how's that worked for you?
Again, it's been a little bit of everything, where I think Microsoft specifically, our call to action is for suppliers to submit projects to us through our open RFP portal, which at any time of the year, a supplier could submit a project to us for review. And sometimes through that process, we get projects that are submitted that might have a really strong on-the-ground focus, might be someone who's been working in that region or in that jurisdiction for a long time, has a really strong project implementation partner, but doesn't have the upfront financing that they need. So that's where we can work to identify a third party, could be a streamer or someone else, to cover that financing gap. So it's a little bit dependent. I think we're still I think folks have referred to the VCM as the Wild West. I think we're still in those days a little bit, in that I think it's just an all of the above.
Okay. Hopefully slowly becoming a little more tamed. But okay, I'm going to sneak one more question in here before the buzzer. This one's for you, Xander. It's such a good question. How do streaming arrangements interact with third-party debt financing? Is it an either or is there a role for both?
Great question. It depends on the project type. I think there's often a role for both. So one example is biochar projects, where there's typically a facility and a pyrolysis piece of equipment that banks are much more used to lending against and then taking security on, whereas they're not typically comfortable doing that with carbon. So like in biochar is only a portion of the capital stack, whereas in other more nature-based solutions, we're typically a much greater share of that. Although I would say you're starting to see the market evolve, and you're starting to see the World Bank, you're starting to see other folks come in and lend against. They're starting to see carbon as an actual something that they just value at zero. And so, I think in order for this market to really scale, we have to unlock debt markets, and we have to show the value of carbon to the debt markets. And that's starting to happen. There have been a few exciting developments this year, and just hoping that that trend continues in the near future.
Thank you so much. This has been such a great conversation. Thank you, all of you, for joining, and for everyone in the audience who submitted amazing questions. I'm so sorry I couldn't get to all of them. but we are at time. So I'll just remind everybody, in the bottom of your screen, I think it's a green button that says resources. And if you click on that, you can download or you'll have links to a number of resources, including Xander's slides from today. There's also a discount code for Verge. I know Xander and Steph will both be there. Mitch, I imagine it's a pretty long trip for you to get to Verge this year. But so anyway, check out those goodies in the resources section. And once again, my gratitude to each of you for joining, everybody in the audience, and for the folks behind the scenes, Julia, for making this whole thing work so smoothly. You make us look good. So thank you so much. All right. And I look forward to our next conversation. Have a great afternoon.